So, Steven, you're telling me that I can literally raise my credit score by 100 points in 30 days? That's incredible.
Yeah, absolutely not.
All right, guys, what's happening? So this is another episode of The Brook Report, and I'm here with Steven Roberts, and he's with Better at Credit of America. I'm just pumped to have you, man.
David, thank you so much for having me.
Well, here's the biggest thing that I think a lot of real estate agents are facing when they talk with clients, who want to buy a house, and unfortunately, their credit scores are just not where they need them to be. They end up saying, "Oh, great, you want to buy a house," and then all of a sudden they get referred over to a lender, some sort of loan officer.
Yep.
They go through that process of getting that pre-approval, pre-qualification, and all of a sudden they find out, oh, junk, the guy's credit isn't where it needs to be. And then they don't know what to do from there. And many times real estate agents end up just saying, hey, come back to me in a little while. Or a big objection from buyers is, I'm just going to wait a little bit in order to improve my credit. They have no idea that guys like you exist. So
Right.
What is it that you do?
Everything you just said. I help people understand what credit's all about. And that's the thing I've been doing for the past 15 years. There's so much misinformation out there about what is in credit, what's not in credit, how it works, how to boost your score in 100 points in 30 days, like all these shenanigans that aren't really valid statements. And it's my job as a credit expert to go out there and work and educate the people of the community about how credit really works.
So how many people, if you just had a rough percentage, how many of the consumer population that's out there, those who are not in the real estate industry, but just the consumers, how many people do you feel actually truly understand credit and how it is calculated and works?
If I'm being optimistic, I'd say 40%.
Okay.
I'd say there's roughly 60% of Americans that really don't have a good handle on what credit's all about.
Really? And how about in the real estate industry? Do you see any difference with that?
Well, I think that's the biggest thing because people are looking to buy homes and they're going out to the experts, right? The mortgage person, the realtor person saying, hey, I want to buy a home. And they're expecting that these lenders or these realtors are going to be able to provide them the information they need. Guess what? They don't even have the information. Yeah. And that's what a big part of my career has been over the past 15 years is doing presentations and working with the frontline people so they can better help their clients.
I'm so excited to do this podcast with you because I think it's going to be massively valuable to people inside of the real estate industry and consumers who may or may not listen to this, but it's so important for them to understand how credit works and what's possible, what's not possible, and hopefully you can provide some education today. Why'd you get started into this? Let's start with that, who you are a little bit.
Absolutely.
And go from there.
Sure. So I started, after I graduated, I did mortgages, fell into it, and did that for 3 years back in 2003 to 2006. Well, back then, credit didn't really matter, but as you saw, kind of helped implode the whole U.S. economy. As things kind of fell apart into 2007, my business partner and I at the time realized, you know what? There's a lot of people that don't understand what credit's all about. Let's start researching that.
So why do we have credit scores in the first place? Where did that start? We understand that there's companies like Equifax and TransUnion and all this. Why do we have that?
It's all about risk.
Okay.
It's the banks putting themselves into a position where they want to be able to calculate risk of those consumers. And they want to make sure that if they're going to be lending money, that they're lending it in a non-risk perspective, or if there is calculated risk, that therefore there's going to be a higher interest rate.
So they understand what risk is, and they're looking to understand what risk is. So we've got one part of the equation, which is the lender who understands risk. But a lot of times that borrower and even the professional who is brokering this transaction, they don't understand it.
Right.
Why is that? Why is there not some sort of course in high school or in college where we understand this, or why does it not appear to be as much education? You would think the government would want to get behind this to educate as many people as possible. Is that one of the reasons that you're a nonprofit at this point?
Exactly. After doing this for 15 years as a profit regular business sector, I've really over the past 6 months made the decision that I need to get out there and do even more education, things like this, to help consumers really understand what credit is all about. And going nonprofit gives me the ability to reach out to a lot more consumers and really give them the education that they desperately need.
Yeah. So let's talk a little bit about that. You started in the mortgage industry. You were realizing that you were able to give loans or to individuals who may or may not have they were a risky bet.
Right.
And then we saw as a community in the real estate industry, we saw that as a country, we saw that as the world, the ramifications of not understanding risk or being so, acceptant and tolerant of that risk, even blind to that risk
Right.
of what can end up happening. So that happens, and then you decide with a couple of friends, you're going to go and help people with understanding credit.
Absolutely. So it was myself and my business partner. We said, let's go figure out this credit thing. We got a kind of fabricated system, started learning it. And through the process of learning it, we ran into a gentleman by the name of John Alzheimer, who really, I'm going to tout he's a legend in the industry, working at FICO, working at Equifax, really understanding how things worked. And we were able to work with him through his different credit summits and trainings and credit expert witness programs and all that stuff, where we got such a good, deep understanding about how credit works. And that's given us the educational platform we need to be able to go to consumers and really provide them the understanding about what it's all about.
Well, for most consumers, we're hearing two different sides of the coin when it comes to being in the real estate industry. And for most of us who would watch a program like this, we're in the real estate industry and we hear two things. Either A, you can't get a loan because your credit is not at a specific level, 580 for certain programs, 620 for other programs, etc. The other side of the coin is you're right at that credit score threshold where you could be understood as excellent credit or very good credit, and all of a sudden your rate starts to drop because you're less of a risk. So in that atmosphere, can you give us a little bit of an understanding as to how credit scores actually work?
So the biggest thing to understand is what you just said, which is what every consumer says. I want to know what my credit scores are. No, you don't. You want to know what your FICO credit scores are, specifically when we're dealing with the world of mortgages.
So define FICO. What is FICO for?
Absolutely. So, because so many people look at this and they're saying, well, but I know a credit score. That's got to be good enough, right? It's the same thing. That's credit scores, FICO scores. Everybody uses it interchangeably, but it's not the case, right? So FICO, Fair Isaac Corporation, is its own private corporation that pulls information from Equifax, Experian, and TransUnion, who are the three major credit bureaus, puts it into its own algorithm, and then spits out a score. Now, the interesting part about that is that there's different types of FICO scoring algorithms. In the mortgage industry, in 2000, when John used to work at FICO, they developed the FICO Classic scoring model, versions 5, 4, and 2, respective of the three credit bureaus. In 2008, they built FICO version 8. 2014, they built FICO version 9. 2020, they built FICO version 10. Here's the thing. They keep building newer versions. They keep passing those out to the public. None of those newer versions are used by the mortgage companies in the mortgage industry because Fannie and Freddie only use FICO Classic still.
So let me understand this.
There's
They
a lot.
keep developing a different scoring system.
Yes.
Like we went into a classroom
Yep.
and your teacher is saying, we're going to grade you differently every single year. But the true way that you're graded, the way that the school grades you, is based upon a classic system that happened 22 years ago.
Exactly.
Very
Which is
interesting.
just absolutely bonkers. And they're fully aware, Fannie and Freddie are fully aware of it. There's been pushes from the CFPB and even from the president to say, hey, please change this system. And their response is, yeah, we'll get around to it.
So is that because the mortgage industry looks at that FICO Classic and says that that's more reliable?
No, it's actually quite the opposite. It's not as reliable. FICO versions 8, 9, and 10 are much better and stronger predictors of somebody's risk, which is the whole point of this, right? The FICO Classic system was great for what it was at that time. It's just a matter of, in order to implement the newer systems, you have to implement underwriting guidelines, you have to update that, you have to update the softwares, and that just hasn't taken place yet. And I don't know when it's going to take place at this point.
That's very interesting. So what are some of the biggest misnomers that people have, the biggest myths that they have about the real estate process when it comes to credit, even their own credit scores when they're going to get a car loan, applying for a credit card, whatever that is? You talked about the difference between your FICO score and actually your credit score.
Correct.
Give us some more.
Well, I think that in itself is the biggest thing. There's so many websites out there that are free websites that give you these credit reports and credit scores. The problem with a lot of these free websites is that they're not giving you an accurate depiction of what your credit really looks like. Number one, it's not always through all 3 credit bureaus. Number two, it's usually based off of only 2 years worth of data, not the full 7 years. Number three, the score range models can go anywhere from 100 to 1,000 points, whereas the FICO scoring model is going to go from 300 to 850. So if somebody comes to you and is like, oh yeah, I know my credit, it's a 900. Well, obviously it's a credit score because FICO doesn't even go that high. So the biggest thing is understanding that all these third-party websites, although they can be good to kind of track some of your progress, or if there's an inquiry that you're unaware of, things like that, fine. But in terms of the actual numbers that they're providing you, completely different than what you would need, especially in the mortgage world. And then it gets crazy, like you just saying with auto loans. That's a wild west right now, because every auto dealership has the ability to use whatever scoring model they want. So you go to Jeep, they're going to use FICO version 8 auto. You go to BMW, they're going to use FICO version 10 classic. You're going to go to, Mercedes, and they're going to use their own scoring model labeled with a Vantage 3.0. I mean, there's so many different scoring models out there that they're providing to the public that it's hard. You can go to 10 different dealerships within a week. You have 10 different complete scores, and your head is spinning.
So why is that? Like, why are they trying to confuse the public, or are they just trying to understand their own risk?
They're trying to understand their own risk, and that's really what it is. Whereas the mortgage world is stuck in that FICO Classic, and therefore everybody understands this is the risk we're taking. In the auto world, they're all looking at their own risk, and they're just saying, well, Jeep's like, well, this is what we feel is the most accurate depiction of risk. And this is what Kia feels is the most accurate depiction of risk, or whoever it is. So yeah, they're looking at for risk. They're just trying to find their own way in doing that.
Interesting. So if you speak to a customer and you hear from them and they say, hey, I have a credit score of 700 and I'd like to get it to 740 or 760, is there an analysis process that you have in order to determine, here's how we raise your score?
Absolutely.
Okay.
First question, where are you getting that number? That is, people call me, I'm trying to qualify for a mortgage, and right now I have a 720. Oh, that's great. And where are you seeing that number? Oh, I use this free website over here. Okay, so did you actually have a lender pull it? Well, no, not yet. All right, well, then we need to actually have a lender pull it to see what you can qualify with. They go, they get it pulled. Guess what happens? That 720, it's now a 680.
Really?
Is that going to change what they're going to be able to qualify, their interest rate? Of course.
Yeah.
And people are blown away. And then they get mad at the mortgage person or the realtor being like, whoa, whoa, whoa. No, you guys are using the wrong thing. Unfortunately, it's a consumer that's using the wrong thing because they're looking at a free credit score versus a mortgage score.
This sounds exactly like our consumers who we deal with every single day and we serve, and we go into their homes and they say to us, well, Zillow says that my property is worth, 640, and you're telling me that my property is worth 600.
Right.
What are you missing that they understand? And I'm like, I get it. I get that it's highly popular. I get that it's free. Let me just ask you, when was the last time that Zillow ever walked inside of your home and saw the condition of your property? And they don't. It's just an estimate.
Exactly.
So what is the purpose of these websites? Zillow wants eyeballs because they want to advertise and they want to sell leads to realtors, et cetera. And there's, their monetization model, goes further than that. But for these other websites, I'm guessing like Credit Karma and, freecreditscore.com or whatever it is, what is the purpose of those websites and why do the consumers go there?
Well, first of all, that's an excellent point. What I'm talking about is exactly the same equivalent of a Zestimate, right? And really, I think it's the same thing. They want eyeballs. They want marketing. All these free websites are just looking to get people there because people understand credit's important and they understand they should look at it. They just don't know what they're looking at. And so if they're not being educated as to what they truly should look at, they're just happy they're looking at something. And these companies are saying, yeah, we're providing something, and it's something. It's just not really an accurate representation of anything that's going to be useful.
Yeah. So let's get back to the credit score, credit report, how it's compiled. Give me the ideal, right? So someone walks into your office and says, here's my credit report. Here's what it's made up of. Mm-hmm. What would that ideal, perfect report look like? Is there any sort of composition that makes it as attractive and zero risk or very low risk to a lender?
Yeah. So There's two questions in there because there's, well, again, staying in the world of the FICO score, there's what goes into your FICO score, right? Very simple. And people make it much more complicated than it needs to be, but there's really 5 components, okay? 35% of our scores are past delinquencies. So that's your late payments, did you have a collection, anything like that. 30% of our score is debt utilization. We can come back to all of these, by the way.
Yeah, we'll go through them.
Right. But 15% is the average age of the credit file, 10% is the perfect mix of credit, and 10% are inquiries. So it's really simple if you're just working within those categories. Now, to answer your other question there, very simple. If you have somebody that has no late payments, no collections, if their utilization is under, let's call it 10%, if they have a longevity there where they've had cards open 5, 10, 20, 25 years, that longevity is going to be huge. If they have the correct mix of credit, if they have 3 credit cards, if they have a car loan, an auto, a mortgage, and maybe even a couple of student loans. And if they're not constantly applying for new things, you can easily be above 800, or really 760 is the gold standard, because at that level, you're getting the same interest rate, whether it's, if you're at a 782 or an 820, it doesn't matter. You know, pat yourself on the back, you're at 820, but you don't need anything different. You're already above the 760 and you're gold.
Awesome. Okay, so let's go back to some of these components that make up that ideal.
Sure.
So the first one we talked about was our delinquencies, right? So delinquencies show up in the mortgage industry quite often in terms of, hey, did you miss a mortgage within either the last 12 months, 24 months?
Yep.
We understand that. Anything else that's going to drastically affect your credit score? Tell me about reporting. Someone is late on a payment. Is it always reported? How about rent? What about utilities? Any delinquencies with that? How does it affect your credit score that way?
So, there's so much to say in this category.
Yeah,
so I'm going to run with it.
Let's dig in, yeah.
And I'm going to start with a story which really just kind of blew my mind. This happened in January 2020 because I'll never forget it.
Okay.
And this guy was an older gentleman. I think he had about 35 years of credit, okay? He was some type of an accountant mathematician type guy. He ran through it and gave me the numbers. 99.978% of the time, all his credit was paid on time. The previous month, something happened. He missed his mortgage payment. It went from a 780 to a 682. One mortgage payment after 35 years being late dropped his score about 100 points.
Interesting.
And it's just crazy because it takes years and years and years to build up this great credit. 1 month of a mishap, and boom, the score can just absolutely drop.
So, and is that different? Because a consumer may ask this, a real estate agent might have this question. Okay, my client or myself, we missed a mortgage payment.
Right.
Is that different than missing a car payment? Is that different than missing, your utility payment?
Right. So anything that's being reported, so like a mortgage, an auto loan, a credit card, yes, there can be variances, right? So a $3,000 mortgage payment, they're going to score you more harshly versus your $20 minimum on Macy's that you didn't pay, because maybe you forgot that versus, hey, you didn't have the $3,000 to pay. So yes, there is a difference there. But you did bring up utilities. Utilities are not scored in the FICO Classic scoring model. Back then, in the year 2000, they weren't accounting for all of those. And if you think about it, a lot has changed in the past 22 years.
They have, yeah.
So the only time utilities show up is when they become derogatory, meaning that you had a utility like a gas bill or maybe even a cell phone, and you didn't pay it. Now it goes to a collection. Boom. That new collection going on your credit report, easily drop your score 50 to 100 points.
What about medical? People ask me all the time about medical.
Medical. So let's take a trip down memory lane. In 2017, the people at the credit bureaus decided, you know what? We feel there's too many people that have judgments that are not a fair representation that they belong to them. So in 2017, they said, we're going to wipe out all judgments off of people's credit report. In doing that, it gave a nice boost because all these judgments that were currently being reported are now no longer being reported. Well, the credit bureaus in their infinite wisdom have now done that again on the medical debt side of things. Very interesting considering that we're just about to hit this, but as of July 1st, all paid medical collections will be deleted from the 3 credit bureaus. So if you have somebody right now that has open medical collection debt and it gets paid in the next 30 days, when the report is run after July 1st, that information will no longer be there. Open medical debt still will be, and there's changes coming to that as of spring of 2023. I'll have to come back on for that. But all paid medical debt as of July 1st will be removed. That's going to give a nice boost in the score because a $30 copay can still drop your score 50 points. And if you can get that paid and that gets removed, you can be in a whole different stratosphere of what type of account you can apply for a mortgage.
Wow, very interesting. Let's move on to the next topic there. You talked about debt utilization.
Yep.
So debt utilization, define that for the listeners, how they can best understand it, and what they should do. Is there an ideal range for debt utilization?
Absolutely. Debt utilization, just to be clear about this, is completely different than debt to income ratio. And I hear that all the time.
Okay.
Oh, DTI. Yeah, my loan officer talked to me about that. No. DTI is how much money you bring in versus how much money goes out. That's a finance thing. On the credit side of things is debt utilization. How much money do I owe versus my credit limits? So very simply, if you have a credit card with a limit of $1,000 and you owe $1,000, you're at 100% utilization. That's going to hurt your credit. You know the next comment I always hear? Oh, but Steve, it's okay. I max out my card every month, but as soon as I get the bill, I pay it. Here's the problem with that. The credit card companies only update the credit bureaus one time per month. So the day that client gets a bill, that $1,000 balance, even though they pay it that day, that $1,000 balance has already been reported to the credit bureaus. And that's what's going to show up for the next 30 days.
Interesting.
And what does a client do over the next 2 to 3 weeks? Well, they use the card. So by the time the next billing cycle comes through, it's maxed out again. And they're perpetually caught into this cycle of having high utilization, which is holding their scores down.
So is it recommended for a potential increase to ask your credit card company in order to increase your limit so that your debt utilization ratio actually declines?
It'd be a great thing to do if you can do it and if they're willing to do it. However, there's 2 ways to do it. Okay. The first way is to call them and say, hey, I've had great credit with you for the past 5 years. I want you to increase my limit based on my history. That's fine. They increase the limit. You're good to go. It lowers your debt utilization. The other side of it is to say, hey, I've had credit with you for the past 5 years. I didn't have the strongest credit when I first opened this card. Now my credit's amazing. Please pull my credit report, counting as an inquiry, and because of that, give me a higher level increase. So it is a way to increase your credit, but just understand there's 2 ways to do it. One is purely beneficial. The other one can be beneficial, but you will be taking that hit for the inquiry.
Interesting.
And back to your original question, which there's so much content about it, right? What's the best utilization? If you're really under 10%, you're golden. What I tell people is I don't care if you have a $300 credit limit or a $30,000 credit limit. You should put like 10 or 20 bucks. I used to say tank of gas, but that's out the window right now.
Yeah.
So put 20 bucks on your card every month. Wait for the bill to come in the mail, paid in full. That's the best way to build and establish your credit. I get it. Your tire blows. You need to put $500 on a credit card. I get it. Sometimes you have to float things. But in the grand scheme of things, put 20 bucks on your card every month. Wait for the bill to come in the mail. Pay it off. You do not get bonus points for maxing out your card and paying it off. I hear that all the time. Well, I heard that if I pay my card in full and it's maxed out, I get more credit. No. All you're doing is paying. You're just burning more money. You're not going to get any bonus points doing that.
That's interesting. Any other myths around debt utilization that you hear all the time? And let's say there is a 10% ratio. Should customers, as they come to you, how do they reduce that amount of debt and get it down into that limit? What are some of the strategies that you provide for them?
Well, one of the biggest things I hear all the time is, okay, yeah, that makes sense. I'll just start closing these cards. Worst thing you could do. You never want to close down credit cards because that in itself could be messing with your debt utilization. And if you think about it logically, right? If you have 2 cards, each one has a $1,000 limit. This one's maxed out. This one has a 0 balance. Simple enough. Right now, you're only at 50% utilization. Not great, but not terrible. If all of a sudden you say, you know what? I think I just could go ahead and close down this card. Or, by the way, after 6 months of inactivity, it gets closed on you. So now it goes away. What just happened to our utilization?
They went to 100%.
100%. And what just happened to our score? Boop. Tanks. So something as simple as, I'll just close down this card, or I'm going to just cut up the card. I'm going to stick it in my drawer and not use it. You might think you're helping yourself, but you might be shooting yourself in the foot with a debt utilization aspect of things. So you got to be careful about those things.
Great. Anything else you want to talk about debt utilization before we move on to inquiries?
I mean, I could keep going with debt utilization, but let's keep going with the inquiries and we'll go from there.
Okay, awesome. So let's get into inquiries. This shows up a lot for us in the real estate industry. We'll hear things like, well, I don't want to go to that other mortgage company. You know, somebody starts off that maybe they're banking with, like Bank of America or Wells Fargo. They've got their checking accounts there. They walk in, they say, you know what, I banked here. There's some sort of like idea that, well, I'm going to get a better rate because I actually have my, my checking account here or whatever it is. So they say, okay, I'm going to go and apply for a mortgage. They go get a pre-approval. They come to us. We say, listen, we'd highly, recommend to you, you can go to anybody you want. However, we found some unicorns in the industry who do amazing work. Watch the podcast and find out who they are, right? But we would recommend that you at least get a second opinion like you would for anything,
Absolutely.
medical or, financial. They say, no, I don't want to because I don't want this to hurt my credit score.
Right.
Huge, huge question that consumers have. What would you say to this?
You don't have to worry about it. And the reason you don't have to worry about it is because the way the FICO Classic system is built, and again, specifically for the mortgage world, actually auto in this regard, is that you have a 30-day window to go shopping around, and it's only going to, you could have 10 inquiries within 30 days, go to 10 different mortgage people, really find the right person you're comfortable with, the right interest rate, the right product, all of that. All 10 of them will be listed, but because you're applying only for a mortgage within that time frame, it's only going to count as one inquiry. It's only going to drop your score. How much does it drop your score? It depends on where your credit overall sits, but anywhere between 5 to 15 points for that one inquiry. But you can shop around. You have 30 days, and that also applies for auto loans.
So that applies for auto. So if I was to go out there and I said, hey, I wanted to buy, a Mercedes or a Tesla or a BMW, it doesn't matter. I can go to any of those dealerships, apply for a loan, and it will work the same way.
I just had a conversation a couple of weeks ago, and this guy had gone to something like Joe's Auto World or whatever it was, and they're like, he shopped my loan around, and there's 10 inquiries all in the same day. My credit's a 550. No. Your credit's a 550 because you have terrible credit and you can't pay your bills. I was like, it has nothing to do with these inquiries, honestly. So you gotta make sure you're taking care of credit issues. And I think that's something that we eventually need to talk about is what it takes to actually get to the point where if you do have issues, how do you get them resolved and how do you go through that process as well?
Let's talk about the other two components that make up your credit score and your credit report. Go into a little bit about that and how, some of the myths about those and some of the top things that consumers and real estate agents should be aware of.
Definitely. 15% of your score being the average age of your credit file is huge. And people underestimate this one a lot because it's even bigger than inquiries. And yet it gets talked about so infrequently. And the biggest time this comes up, holiday shopping. Oh, I'm going holiday shopping. I walked in this store and Macy's offered me 40% off to open up a credit card. I got it. I heard I wasn't supposed to do it, but I'm going to beat the system because I'm going to open it this month, get my 40% off, pay it off next month, and I'm going to close it. Boom. Nope. Doesn't work like that. Number one, you just took a hit for the inquiry because anytime you apply for any credit card counts as an inquiry. But in terms of the average age of the credit file, an account does not get factored out of your average age of the credit file just because it gets closed. So many people think that, well, if the account's not open anymore, it's not impacted anymore, right? No. If you had say you had one account your entire career, and no matter what it was, and it was a credit card from 10 years ago, and now you go and you open up a credit card this month, and you're like, well, I'll just pay it and close it next month. You just took your average age of your credit file from 10 years to 5 years just to save 40%. And
very interesting.
Collectively, and here's another thing people don't realize, is that if you do anything to your credit, it doesn't matter if you're not impacting that particular card, right? So say you have a Capital One credit card and you're paying on time and everything's golden. And then all of a sudden you do something over here, like lower the average age of your credit file, or you have a new late payment on a Chase credit card or Bank of America, whatever it is, or there's a new collection that pops up. The Capital One has the ability to say, we can do an account review, and at any moment, we can close your card, we can lower your limit, or we could jack up your interest rate, even though it has nothing to do with this person's card. It has to do with the other things on their account. And people don't realize that it's all intertwined and that they can, by doing one thing, it can totally impact them somewhere else.
What we're getting is like this very holistic picture that credit is almost like the body. It's like if you do something over here, it may affect something over on the other side, and that there's some sort of, master brain that's kind of working on all of this, and that's kind of determined by these credit bureaus and how they're reviewing the risk of what a consumer is doing.
Yeah, and just to clarify, the credit bureaus themselves are simply data warehouses. Those are companies that are providing the information to Equifax, to Experian, and to TransUnion. It's all these credit, whether it's a credit score or a FICO score, that are pulling in the data, putting it into its own little algorithm, its scoring model, and then kicking out numbers. That's where it's all coming down. That's where the rubber hits the road to say, is this person going to be a risk or not? And it's up to that company to determine what they want to use to determine that risk, except for the mortgage world, which, again, we're stuck in the FICO Classic.
Mm-hmm.
So,
very interesting.
Yeah, there's a lot to it, and I think that's a very good way to put it, is that it's so encompassing that, you're over here, you do something, and it impacts this, and you didn't even realize it was going to do that.
Interesting. The last component of the credit profile.
Right. So 10% of our score being the perfect mix of credit, you have a mortgage, home equity line of credit, 3 to 5 credit cards. Now, I know somebody watching is going to say, oh, well, I have 8 cards. I guess I should go close them. No. Like we just said, you do not close those credit cards. You don't want to do that. You can still have 8 credit cards and have an 800 score. You can have 2 credit cards and have an 800 score. It all depends on what your overall credit profile looks like, right? They want to see a auto loan, and they want to see student loans, okay? Well, Steve, I'm 60 years old. Do I really have to go back to school and take out student loans just to have an 800 score? No. It's only 10% of your score. If you have other things that are going to supplement it, it's okay, and you can still have great credit. Perfect mix of credit is although a overview of it, you don't have to have everything in it.
Interesting. Quick question regarding that perfect mix of credit. Let's say you're a married couple. And is it possible for one spouse's credit to affect the other? Is it because we see this all the time in the mortgage industry where we have to drop someone off of a mortgage application or include them, et cetera, in order to make that happen? There's a big misnomer that people will say, oh, you know what? Well, my husband's credit score is an 800, but I'm the one who makes the money in the family, so we'll just kind of put it together. And they're hoping that the bank will look at that as reasonable and say, well, she's got the income and he's got the good credit, so together they make a perfect match. So what's your commentary on that?
The problem is it doesn't really matter how much money you make. First of all, that's not even included into any of the scoring models. If you can make $1 million a year, you could not have any money.
I think that's so interesting. People say this all the time. They're like, well, do you know how much money I make? I'm like, I don't care how much money you make. What is the loan officer saying?
Exactly. It's all about, unless you're going to buy it cash, good for you if you can do that, right?
Good for you.
But other than that, you're going to the bank, you have to get qualified. That's great. You make good money. And from a financial perspective, that's fine. But that doesn't impact your credit. And so many times people will open up all these joint accounts, right? Husband, wife, we want to open up accounts together. I always tell people, don't do that. It doesn't make sense. And here's why. You have to look at it from a risk perspective. Again, if you have 2 people and all their accounts are linked together, they're joint account users on everything, and somebody falters, they lose a job. Obviously, this world's crazy right now. What's happened the past 24 months. So all of a sudden they can't pay something and they get a new late payment, this other person is sinking also. So my suggestion always is when you're building your credit profile, when you're doing what you need to do, open up your individual accounts unless there's specifically something big like a mortgage where you need to qualify together. But if you have like credit cards or auto loans or things like that, open up them separately. And with the credit cards, what you can do that's absolutely amazing right now is the authorized user relationship. So all you do is open up this credit card, add your spouse as an authorized user, and you guys can build the credit together using that account.
So go into that a little bit more. So someone, let's say, husband and wife opens up a credit card. Yeah. It's under her credit. Correct? Authorizes the husband to be on it. Yep. He builds credit.
Correct. Because basically what happens with an authorized user relationship is you're basically saying, I want this person to be able to lean on my credit.
Can you do that for children? Or those 18 and older?
18 and older, absolutely. And this is how funny this scoring model is, okay? And let's go down that example because this is one of those things where you makes your head scratch. So say you have somebody who is 18 years old and the mom has a credit card she's had for 20 years. And now she calls and says, I want to add my son as an authorized user on my card. Within 30 days, that card now shows up on his credit report.
And the account history is 20 years.
Even though he's only
18 years old.
Crazy, right?
That's interesting.
Now, that's obviously a very extreme example, but that in itself works great. If you have somebody that's like a 610 and you're like, oh, if I could just get to a 620. Well, did you pay down your credit card? I paid off all my credit cards. Everything shows zero. How about this? Do you have somebody in your sphere of influence, a family member, a parent, a friend, a relative, that could add you as a credit card? Oh, yeah, I have an uncle. He has a Chase credit card for the past 15 years. Great. Get added as an authorized user on that card. Wait the 30 days because everything takes 30 days for that to impact the credit. But once it does, boom, you'll be over your 620. Now you can go get your loan done.
Okay, these are like amazing tips and tricks. What else you got up your sleeve?
Well, that's one of the biggest ones there. The debt utilization always is a big thing in terms of how you're paying off your credit cards and understanding that you have to make the payment, bring your balance down to zero, and then leave it there. Don't close it. Never close it, but make sure that once you pay it, you can go through that process. Another thing, I don't know if we're going to talk about it now or later, is how to handle accounts that go negative.
Let's do it.
Because that is huge. And that is one of the biggest things that I have a conversation with a client with, and they're like, oh, I just did this. And I'm just like, oh, no. And here's what I mean by that. When an account isn't in charge-off or collection status, first of all, the debt still needs to be paid. I hear that constantly. Oh, yeah, this charge-off account? Well, they charged it off. And I know it says I owe $850, but it's charged off, right? I don't owe any more money. No, you still owe the money even though it's charged off, okay? They're just tired of trying to chase you. It's basically what it comes down to, right? Now, what to do with that debt? Here's what people currently do that they shouldn't. Oh, okay, I owe this money to the charge-off or collection company. Let me start calling these companies. Let me see if I can wheel and deal, negotiate some type of settlement. Ooh, they're giving me 50% off. Boom, here's my debit card. I want to expedite the process. Worst possible thing you could do. Here's why. Number one, you always need a settlement letter in writing with a specified date. Number two, you should never, ever give out your debit card, credit card, or checking account to any type of charge-off or collection. You have to protect yourself financially.
What's going to happen?
I knew you were about to ask that. Let's do a real-life example, okay? This happened about 5 years ago. This lady came to me after the fact, unfortunately. She had a collection with Verizon, went to a collection company. They called. Finally, she's like, okay, fine. I know I owe $1,000. I'm not willing to pay that. I'll pay you $600. They said, fine. Gave the debit card to ABC Collection Company. She thinks she's golden, right? About 4 months later, XYZ Collection Company calls and says, hi, we're calling you about your Verizon debt. What does she say? Oh, I've already paid it. So it's your account. Well, yeah, but I paid it already. Thank you very much for the verification. Click. They then went into the debit card that she gave the first company, pulled out the $1,000.
The full $1,000 after she had already paid $1,600. After she paid $600.
Exactly.
Interesting. So she paid $1,600 for a $1,000 debt.
Exactly. Legal? Absolutely not. Are there collection companies out there that are this shifty that will try that stuff? Absolutely. What do? Protect yourself. Get the settlement letter, and if you're ready to pay it, money order or certified bank check only so they don't have your personal financial information.
Interesting.
Got to protect yourself.
Wow.
But here's the other side of it. People think, well, as long as it goes down to zero, it's not going to impact me anymore. Or, well, if it's on my credit report, then or if I pay it, they have to take it off my credit report, right? If it goes to zero, it doesn't hurt me. Or, well, they said they were going to remove it. I talked to him. You sounded so nice. Great guy on the phone. They're full of fluff. They're telling you what they want to hear so that they can get their money. The way the FICO scoring system is built, and this is really what blows people's minds, is based off of 3 letters, okay? Date of last activity. For example, if you have an open collection and that date of last activity is from 2018, and here you are, and now you've listened to this podcast, and you say, this is great, okay, I'm going to handle this. You get your settlement letter. You go and you pay them. You send a money order, okay? Then you follow up. You get your zero balance letter. You're all proud of yourself. You send it to the credit bureaus. All of a sudden, you're watching your scores. What do you think happens? They're going to go up or down?
I would hope that it would go up.
It's going to go down.
Why is that?
It's going to blow your mind. It's because it's the activity date. That account was based all the way back in 2018. Now it's paid off as of 2022. That activity date, you made it a more recent event. You pulled off the scab. By making it a more recent event, the FICO scoring algorithm doesn't really care it's paid versus open. It cares when it happened. And now because it happened more recently, there's a drop in the scores.
Is there any workaround?
You can try to work with that original creditor. Obviously, medical debt is going to be huge because that doesn't matter. It's automatically going to get removed through the credit bureaus. That's great. You could try to work with the creditor. Hey, if I pay this, will you go ahead and remove it? In general, they're not supposed to or really allowed to do that, but there are companies that kind of skirt the line, if you will. And then there's certain methodologies that I work with my company that I work with the credit bureaus through the dispute process to make sure that we can actually get it removed. So there are things you can do. It can just take longer. It can take more time. And the biggest thing to think about is the amount of time it would take and the hoops to jump through to do it properly far outweigh the fact of, well, I'll at least just pay it and then hope for the best and try to dispute it.
What's the best way to dispute anything with the credit bureaus? How do you handle that when a client comes to you?
Absolutely. There's a lot of online platforms that you can use. The problem that I find with that is it's very generic. And there's a lot of just like, hey, take this off. I don't know that it was really late, or, oh, it's not mine. Well, it's not yours. They have all your information. They saw that you made your charges. They saw you shopped at Target. These are yours, right? Like just saying it's not mine is not going to do anything, right? You have to make sure that the whole way and the reason you would dispute something is because the Fair Credit Reporting Act, which is the one guiding thing that helps us as consumers, says it has to be 100% accurate and verifiable. So that's what you go after. You go after, can that particular creditor prove the accuracy and validity of this information? However, and I really want to point this out because there's a lot of credit repair companies out there that will say, yeah, we're going to use that concept on open debt. And it doesn't make any sense. And think about it this way, right, David? If somebody owed you $2,000, okay? They sent some paperwork, you're supposed to fill it out within 30 days, whatever, you don't do it. The very next month, do you forget about it or you want to get paid?
I still want to get paid.
Exactly. So to try to send a letter to a collection company or a credit bureau saying, oh, blah, 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 please take this off, even if it temporarily comes off the credit report, the next month as that company does their accounts receivable, they're going to say, hey, we didn't get our money yet. Why'd that fall? Put it back on. And goes right back on the credit report. And that's how a lot of shady credit repair companies, because there's a lot of them, that's how a lot of those try to do that. Or they'll do the other worst thing you could do, sympathy letters, which is, oh, my dog's sick and I hurt my foot and I couldn't go to work that day. And because of that, I didn't get to mail out the check and that's why I was late. Please help me out.
And what happens there?
Well, nothing, because all you literally did is solidify. The Fair Credit Reporting Act says prove the accuracy and validity, and now you're sending them a letter that's proving that it's accurate and valid, that you know that it was late. You're just asking for forgiveness. They're going to be like, well, we don't even have to do our job. You did it for us. Thank you. So sympathy letters are not something you ever want to try to apply for.
So
try to do.
Who contacts you? Is it individuals who, for whatever reason, missed a mortgage payment after 35 years and all of a sudden it drops to a 680 and they need to get it up from there? Is it those who are at, 400 credit score? Is it those who are, that 720 and want to get to that 760? Where is it for you? How do you help the most amount of people?
Absolutely. First of all, it runs a gamut. I've literally had high-end finance people, doctors, lawyers. I've had people that are just released from prison that are looking to get back on their feet, people that just went through divorce, people that just had a major medical thing, a car accident, all the people in between. They're just living their lives daily and something weird pops up. I just had a lady, what's today? Friday. So this must have been like Monday or Tuesday this week, freaking out, calling. She's like, a medical bill just got hit. What do I do? Now, obviously, because of what the just passed, I was like, this is perfect. Here, pay this, you'll be good. She's like, that's it? I was like, yeah, because of this and this. Like, they're going to remove it. She's like, I can't thank you enough.
That's
and she took about an 80-point hit, and she was about to try to qualify for a loan. So sometimes it's just about education. And that's, again, why I'm doing the nonprofit, is to help people educate people. And as we get ourselves up and going, because this is a new venture for us, we're actually going to have a back-end system where people can log in and get a whole educational library.
Incredible.
Where they can say, well, what happens if I need to open up a secured credit card? Boop, let's watch this video, or let's read this article. How does an inquiry work again? I saw the podcast, but I just want to see a quick step. Boop, let's see what that's all about. So the education, and people just need to be able to do that. And that's something everybody that comes to me is going to have for free. That's part of just what I offer to try to build the education that this country needs. On the flip side of that, those people that have 5 collections, 10 collections, a lot of late payments, maybe they paid off all their open collections. And they're like, oh, Steve, you're absolutely right. In the past 3 months, I paid everything. My score dropped 80 points. Now what do I do? Well, now we have to go and fight through the Fair Credit Reporting Act with the credit bureaus and try to really see what we can do to utilize that Fair Credit Reporting Act to our advantage and go through that process. So it runs the gamut. It really does.
Yeah, it's really interesting too. Is like people should really see the value in your services, because think about the difference of that interest rate that you could get if you were at a specific credit score or not, or how much you're going to pay over the course of that loan.
Right.
In the difference. So for whatever fee that you're charging, likely, if you're just doing some simple math here, what you'd pay in interest over the course of 10 years of the loan at a specific interest rate versus a better interest rate with having you on their side. Hopefully consumers and obviously the real estate professionals here can reach out and contact you so that they can actually bring some value to their clients in this aspect and really save them a whole ton of money.
Without a doubt. I mean, for what I charge, which is a very reasonable price, and just to fully understand, I look at everybody's everybody's credit report. Everybody's unique and different. Okay, your credit report is your own little fingerprint, right? It's what is happening in your life, and guess what? What's happening in your life is completely different than happening in Bob's life or Sue's life or whatever, right? Everybody needs to be treated as an individual, which is another thing I really focus on. I'm not a big company. I just been doing this for 15 years. I have a great understanding of what it's all about, and I look at everybody as an individual that needs the care to be able to say, what can I help with them? Yeah. And some people is a quick conversation with this lady earlier this week. Another person is, hey, this is going to take 6 to 12 months, and it's going to cost X amount of dollars, but when you go from a 600 to a 700 and your interest rate drops by a point, and that saves you thousands upon thousands upon tens of thousands of dollars over the next 30 years that you're getting this loan, isn't it worth it? Yeah. And isn't the time worth it? And that's the biggest thing. People come to me all the time. I'm at a 560, and in the next 30 or 60 days, I want to get to a 580 just so I can qualify. Well, that's great. But do you understand like what you're actually getting into at that 580? And versus why don't you just rent for another year, which I know is tough because the market is tough and there's not very rentals out. And I understand that. Or maybe can you extend where you're currently at? Let's take that 550 by working with me over the next 6 to 12 months to a 700. And then you're all set. And then you'll have great credit. Not only do I work with removing the negative debt, I'm educating them throughout this entire process.
Great.
This is how you have to use your credit card. This is how you have to build credit. Hey, don't do this. Don't apply for this. This is how this inquiry is going to impact you. I'm there through them every step of the way to make sure they understand what they need to do.
Incredible. Was there anything else that you'd like to share with the consumers, share with real estate agents out there? What is, any big mistakes that you see real estate agents make that you'd love to just educate them on?
Do your research, okay? And I'm going to jump on this, and I think it's okay to talk about, but there was just a company that got nailed by the FTC for being a fake credit repair company.
We see this all the time.
The sad part is, with everything that happened in 2007, 2008, 2009, the whole implosion, a lot of those people that weren't doing the correct things with the mortgages, they fell into either collections, which we see a lot of shadiness there, and they all fell into credit repair, unfortunately. Now, I fell into it, but I was able to get educated and really bring it above board and really help in educating the consumers.
Yeah.
But a lot of companies don't do that. They just focus on, let's sign people up and let's do this. And, oh, look, hey, you can even sign other people up. You can get paid. I was so happy to see that the company got taken down as this fake credit repair company, because they've been a thorn in my side ever since they infiltrated Connecticut about 7, 8 years ago.
Multi-level marketing, that whole
Multi-level
thing.
marketing, yeah. They do other things, and the whole thing got shut down, and it's just fantastic. So the biggest thing I could say is do your research. Make sure that if you're going to be working with somebody, or if you want to refer somebody, or if you're going to get education, yeah, you can go to YouTube and type in blah, blah, blah. How do I do this? That's fine and dandy. But is that information correct? Well, if you listen to John's podcast or his YouTube video, absolutely. If you listen to me through these podcasts, or if you're connect with me on social media, you'll see that I'm posting things about it. Or you know what? Like you said, I'm available. Reach out to me. Steve, I have a question. How does this work? Yeah. Steve, I have a client. This is their situation. What should we do? Should we review their credit report? Yeah, that's a good question. You know what? Based on what you said, let's review it. Yeah. Let's do that free consultation. Let's see exactly what we have to do to help this client and see if it makes sense for us to work together. I've had clients that come to me, they have $20,000 in open collections. I'm like, okay, I can help you with this. Do you have the funds to do this? No, I'm living paycheck to paycheck. Well, how can I, in good conscience, take you on as a client when I negotiate this great settlement for you, you don't have the funds to pay it? It doesn't make sense. Conversely, Steve, I'm at a 720. I need to go to 760. Well, let's see. You don't have any negative information. Here, let's work on your debt utilization. Why? What's that? Well, let me explain to you how credit cards work. Oh, but I pay off all my credit cards every month. Yeah, but do you know they only report one time a month? They do? Yeah. So let's get all these down to zero. Do not close them. Let's wait that 30 days. Boom, you'll have your 760.
Wow.
Oh my God, how much do I owe you? Not a thing. Free consultation. I just want to give you that education, and the people that I can work with, I work with.
That's amazing. What's the best way that real estate agents, consumers can reach out to you? What's the best way on social media, website? What is it?
Absolutely. So I have Stephen Robert on Facebook. I have bedrockcreditamerica.org. They can go there as well. Stephen Robert at bedrockcreditamerica.org. On my cell phone, 617-939-3447. They can contact me anytime. When you're your own business owner, even as a nonprofit, I'm always working. So feel free to reach out at any time.
Stephen, thanks so much for joining me, man. Appreciate you guys listening. Join me next time.
Thank you so much, David.